Welcome to another 21 Hats Dashboard. I'm Lauren Feldman, and I'm here with Gene Marks. Hello, Gene.
Hello, Lauren.
Great to have you here, Gene, as always. Since we last spoke, you've written a couple of interesting pieces about the GOP tax bill that has passed the House but is still being debated in the Senate. Let's start with the article you wrote that lays out what's in the bill for small businesses. What do you think are the most important provisions?
I mean, there's lots of different things that impact small businesses in the bill. But, just to focus on the top three that I focused in this article that I wrote for the Philly Inquirer, Lauren, is, and I'll go down them. The biggest one is the pass-through deduction, right? This is some people call it it's the qualified business income deduction, or the Section 199A deduction for all of you, CPA wonks that are out there. But it is, the deduction is, again, if you run a pass-through like an S corporation or a limited liability company or a partnership, and as you know, whatever money your business makes, it passes through to your individual tax return. In this example, if you make $1,000, in your business, you don't pay any taxes at the business level. You pay taxes on your individual level. There was this qualified business income tax deduction that started in 2017, which allowed most businesses like this, not all, but most, to deduct 20% of that income before it went down to their individual return. So if you made $1,000, you would get taxed on $800 of it. And that was set to expire at the end of 2025, which is really, it was a big deal for people that were really taking advantage of this deduction. Well, in the House bill, not only has this deduction been made permanent, but it's been increased to 23% from 20%. And they increased the income levels of some of the small business owners that could qualify for this, which means more business owners would qualify for this. So speaking as one who is fully taking advantage of all of this because I own an S corporation, I'm absolutely thrilled. I get an even bigger tax deduction, and have more ability to qualify for it. So it is it's a real bonus to a lot of businesses.
Let me ask you about that real quickly, Gene.
Sure.
There is clearly this is a big benefit for small businesses. Many do take advantage of it. If there's one criticism of it that comes even from small business owners, it's that it helps a relatively small number of small businesses. For one thing, you have to be profitable, obviously.
Yeah. Nonprofits can't be part of it either. I don't know about relatively small number. I think that's a debatable fact.
Well, clearly you have to be making a profit or you're not going to be able to use it. There are groups that make the argument that if you were spending the same amount of money, but it were some sort of small business credit that everybody got, it would help a lot more small businesses. Do you think that would be a better way to spend the Treasury's money?
Honestly, first of all, a credit is always better than a deduction, just mathematically, because a credit goes against the taxes that you owe, and a deduction just decreases your taxable income. So anybody that anytime you have the ability to have a credit over a deduction, that's always a good thing. But there are certain small businesses that are excluded from this. There's a list of it, and it really determines like what you do. Like, for example, businesses that are in the health field, law field, accounting firms, consulting fields, there's certain thresholds that they have to make. And there's a lot of small businesses that are, service businesses, so, I get that. But for most of my clients, the 7 million employer owned businesses, those businesses that employ people, that have less than 500 employees, most of those clients, most of those companies, if they are a pass-through, are really able to take advantage of a good part of that deduction. So it's a benefit. It really is. So that's where I stand on it.
Next on your list?
So there's the bonus depreciation deduction as well. Now, this means that if you buy assets in your first year, you can fully deduct those assets as long as they're placed in service. That deduction was 100% back in 2017 and 2018, but then it started going down and down. This year, if this didn't get passed, you would be able to deduct 40% of your first year purchases against income, and then you have to depreciate the rest.
Wait, you say first year? I'm sorry, Gene. You said first year purchase it. You mean you can anything you purchase, you can deduct
40% of the cost.
in the
That is
first
correct.
year.
In the first year,
Right.
correct. And then you have to then amortize or depreciate the remainder amount over the remaining life of the asset. Next year, it'll only be.
And then this is for capital equipment,
It is. It
or
is for equipment, machinery, furniture and fixtures, computer hardware, software. So a lot of stuff. Not property though. Not real estate. So when you deduct that, this year you can only take 40% in the first year, and then you have to depreciate it after that over the life of the asset. Next year, that would have only been 20% a deduction that you can take. So the House bill restores it to a full 100%, and it restores it going back to any purchases that were made after January 19th of this year going forward. And it expires. By the way, it's not a permanent deduction. This deduction's never been permanent. It expires in 2029. So you've got 4 or 5 years to take advantage of it until it's going to be up for expiration at another date. And the other thing, just to keep in mind, which is no different than before, but you have to put the asset into service during the year. You can't just buy the asset and mothball it. It's got to actually be plugged in and working and in service. And I have a lot of clients that take advantage of the deduction and finance it. I mean, you can finance a piece of equipment in December. You can get it in operation in December, but you don't start paying the loan back until 2026, 2027, whatever the terms are. You can still take the deduction for that cost in the first year because you put it into service. So that's a big deal. It's in the House bill. It's in the Senate bill. I don't expect there to be any changes in the Senate bill either. I do expect that to happen and go through as well.
You don't expect any changes in the Senate bill related to this, is what you're saying, right?
Right, correct. Related to this. That is exactly right. And then the third and final item is research and development expenses. There are not enough companies that take advantage of this deduction, by the way, because there is a wide definition of what counts as research and development. Some people think that it's just for pharmaceutical firms, but it's really not. It's really for people that are developing any new product lines. And if you have R&D costs that are associated with you, which you're supposed to segregate. And those costs could be your employees, outside contractors, materials, supplies, the cost of generating samples, market research studies, things like that. Well, starting in 2022, you were no longer able to deduct those costs in the first year. You had to, allocate them separately, track them separately, and then you can only, deduct them over 5 years. You can only take 20% of it in the first year. So that's been restored in the House bill, which means that you can now deduct 100% of your R&D expenses right away in the first year. It doesn't have to be amortized over 5 years. So it gives you more of that first year benefit. That's also in the Senate bill. And like the other two items I discussed, I do expect that to happen as well in the final bill.
And just to clarify what appropriate R&D expenses are, is that something that could affect a professional services business like yours? I mean, if you're carrying a new line and you have to hire somebody or do training or something like that, those expenses count?
It could. So it's getting up to speed on a product or a service. So it can be a service. Also, if I were to pay consultants to do, say, a market research study, to see if it's a viable service in a certain market. Those kinds of things would absolutely be part of a research and development expense deduction that you can qualify for. So yeah, that's a great question. And that's something that you can definitely do. So those three right away are pretty big, just a couple others, just if I could throw out there, Lauren.
Sure,
there's a new
please.
rule, on charitable deductions as well. There's a 1% floor now on a company's income. If you're a C corporation, you can't take a deduction for charitable expenses unless it exceeds 1% of your income. So I question, and I'm curious. My wife runs a nonprofit. We were talking about this. Like, will this incentivize companies that are C corporations to deduct more or not? I can't be bothered if I have to get it up to 1%, or maybe let's spend whatever we got to spend so we do get it up to 1% and get the full deduction. So that will be an interesting thing to see.
Interesting.
And then, again, there, other sort of smaller things that are out there, but they do affect business owners is no tax on tips and no tax on overtime. Now, the no tax on tips rule, the House passed, in the House bill, is that anybody making less than $160,000 a year, that's a tipped worker, who is yet to be defined, by the way, their first $25,000 of income, they can take a deduction against it, so they don't have to pay taxes on that money. So we're telling all of our clients, Lauren, to just reclassify all of your workers as tipped workers, and therefore they don't have to pay any taxes. I'm just kidding. You can't do that. There's going to be a list of qualified tipped workers. Obviously, it's the usual.
But some movement in that direction could actually happen, couldn't it?
Yeah, who knows? I mean, people are going to test, push the envelope on what's a tipped worker or not. It. So they get that benefit. That the Senate is expected to keep those same stipulations in place. It's a giveaway to employees. I wrote a piece in the Washington Times last week, Lauren, that it's not going to happen because politicians don't work this way. But this money, a typical tipped worker will put about $1,000 in their pocket from something like this based on average tips that they make. And, and I think it's found money, and I get it that a lot of people need the money. So don't get me wrong, but it is found money. And I think to myself, man, with the retirement crisis that we've got going on, if I was in Congress, I would have pushed to make this one of these, you can only get the deduction if you take the savings, the tax savings, and put it into a Roth retirement account. A Roth retirement account is for after-tax savings, and it grows tax-free, and you can take it out anytime you want without any penalty. So it's not like you can't get to the money, but it would just incentivize people to put money away in savings and retirement, the tax savings that they got from this no tax on tips thing. But that's not going to happen. It's not part of the bill. I'm just sitting here going way off.
It's an interesting proposal, though. I hope you keep pushing it. Yeah. Maybe one day.
Well, it just gets back to you. You told me probably offline that you would love to see me when I write stuff rather than yell and scream about things I don't agree with to actually make suggestions or what would I do otherwise. And I was thinking about you when I was writing that because I was like, I think Lauren would like this. I'm taking something and trying to make a point here. So there you go. I wrote it for you.
You were right. All right, let's talk about the other piece you wrote, saying that the big, beautiful bill is going to be a big, ugly problem for small businesses. Why did you write that?
Well, rather than me answering, why don't I just turn this over to Elon Musk? Elon, can you come here for a second and explain what is happening? It is, it's a tax and spending bill, and depending on the latest Congressional Budget Office estimates, I don't know, you're increasing national debt by anywhere from 2 to 4 trillion over the next, through 2030. And that's, who knows how accurate these estimates are. It could be a lot worse. But it ain't great when you look at all the spending that's going on here and the taxes themselves that you're reducing. And you and I have talked about this before. As a business owner, how can I not like tax reductions? I mean, that's why a lot of my clients supported Trump. I mean, selfishly, you know what I mean? Like,
Gene, I don't know if you remember, but we had this conversation back when we used to be on Sirius Radio together.
We did.
And we talked about the 2017 tax cuts.
Yeah.
And I would challenge you about some of the giveaways to big corporations, the $40 billion that Apple got. And I think your answer was pretty much, it's great for small businesses. If it's great for small businesses, I'm in favor of it.
I haven't changed that stance, but my concern is growing. And I'll tell you the reason why. Interest rates right now, when you and I talked in 2017, interest rates were like zero. I mean, the prime rate right now is 7.5%. And, I don't expect any significant reductions in interest rates from the Fed over the remainder of this year. Our national debt, we talked in 2017, this was before the pandemic. Our national debt back then was below $20 trillion. It's $36 trillion now. I mean, it is just absolutely exploded. And the interest maintenance on that debt is more than $1 trillion a year and going up. And that's a big, big problem. And, and that's a problem for small businesses.
Why is it a problem for small businesses?
Because here's what happens. First of all, if you ask any business owner, and I know when people say like, oh, well, the government's not the same as running a business, there's a lot that's the same. And if you have a budget that's running $2 trillion deficits a year, there's only 2 ways. Well, actually, there's 3 ways to fix it. The 2 ways is what a business would have to do. Either cut costs. Well, good luck with that. We saw how successful Musk was trying to cut, costs. I mean, forget about that, right? And number 2 is in this environment, or raise revenues. I mean, tax more. and here we are taxing less, right? So it doesn't seem like the government's taking actions to get that deficit under control if it's just a matter of cutting costs or raising revenues for whatever reasons. I'm not saying that's good or bad. It's just that's a fact, right? But then there's a third. So what do you do? If you have to pay your interest expense, what do you do? Well, you print more money because you inflate your way out of your debt. And what happens is you print the money to pay your interest in, and that puts more money into circulation, and that puts a hell of a lot more pressure on inflation. And that causes obviously an increase in costs. And the Federal Reserve, in desperation to keep control on inflation, will have to continue to keep interest rates relatively high, maybe even higher than now. And that impacts our cost of financing and capital. And we live in a capitalist society. So if the costs of capital are too high, it will affect many businesses who can't make the investments they need to make. And that's a problem. And it's becoming a bigger and bigger problem as the interest payment part of our budget gets bigger and bigger and bigger. The money's got to come from somewhere. Nobody's going to raise it through more taxes, and nobody's going to.
Well, actually, there has been a huge tax increase if you count the tariffs.
Tariffs, yeah, right. That maybe you're right. Maybe that solves the problem.
Well, I'm not saying it's going to solve the problem, but it is generating cash right now.
$28 billion in May is what I read. Like it was the highest tariff in ever. So those tariffs are coming in. I don't know how long term or sustainable that is, but
it cannot it can't do both things that have been promised. It can't both solve the debt and restore manufacturing to this country.
Agreed, because as we know, as those tariffs are coming in, are having another inflationary impact. So it's like, you get one thing, but then you're paying for it elsewhere. So, until somebody gets serious about spending by the government, it's a problem. And as the debt grows and as interest rates are what they are, we weren't talking about this as much, 5 years ago because interest rates were so low.
Right.
Now it's becoming an issue. So short term, super happy for tax cuts because I'm a selfish bastard and I want more money in my pocket. Fair enough. But then I am concerned longer term over the next few years, what impact, are all this interest that we're paying. The money's got to come from somewhere. And I just think it's going to cause inflation and higher interest. I really do.
Are you still feeling relatively optimistic that all these changes this year, the tariffs, the big beautiful bill are going to, in the end, produce a happy outcome?
Longer term, I really do believe that we are still in a pro-business environment. I feel the tax decreases that are happening are going to be a huge help. I do feel confident. I think 2025, as we talked about before, is going to be a very disruptive year. And you and I are going to have a lot more talk about tariffs because there's a lot more shit going to happen with tariffs over the next few months. Trust me on that. So, and that's a whole other discussion to have. So,
well, I think we're going to have plenty to talk about for quite some time, Gene. I am glad you're optimistic. I hope you're right. Gene Marks is a CPA who writes weekly on small business for The Guardian, The Hill, The Philadelphia Inquirer, The Washington Times, The Chicago Daily Herald, Forbes, and Entrepreneur. You can also hear him on ABC Radio's Eye on the World with John Batchelor. Gene hosts 2 small business podcasts with Paychex Corporation and The Hartford. Thank you, Gene.
Thank you, Lauren. Talk to you soon.
Have a great week, everybody.